So let's start this meeting of Club du CEPII. So this meeting is about chaos in world trade. So welcome to everyone. And so obviously, why chaos in world trade? So obviously, the war in Ukraine has exposed the world trade to new challenges and new threats, including obviously for the energy sector, gas and oil, but also for commodities in general and agri-food trade in particular. So there are these new challenges that have been raised by the war in Ukraine, but this is the war in Ukraine is just the last of a series of potentially important of a series of crises with potentially important consequences for globalization. So the US-China trade war in 2018, COVID-19 in 2020, and now the war in Ukraine in 2022. So this is a series of important crises, and so they all questioned the organization and the resilience of global value chains. And we thought it was a good time to take stocks of all these different crises and potential consequences. Because if you take a look at the numbers, up to now, the global value chain have been pretty resilient, actually, despite the disorganization and increasing price of shipping. If you take just the latest figure from the World Trade Monitor, trade is 8% larger today than before the COVID crisis, and it has reached its pre-pandemic level as early as early 2021, including for intermediate goods. But at the same time, we have an increase in the price of exports and imports, which is up by something like 20%, and in particular because of fuel and primary commodity prices. And so there are lots of challenges related to this organization of global value chain. At least there has been lots of challenges to these global value chains, and lots of challenges ahead for global trade. And we talk a lot about reshoring, nearshoring, friendshoring, regionalization, including by policymakers, but also by business executives. So we thought it was a good time to take stock and ask, where do we stand on these trends, and do we see some new trends ahead for globalization? And so we have two great speakers for to address this issue. So the first one will be Marion Jansen, and the second one will be Christophe Gouel. And so just to introduce them, and then I will give the floor to them before having some Q&A. And so Marion Jansen is director of the Trade and Agriculture Directorate since September 2020. And prior to that, she has been working at the International Trade Center, the World Trade Organization, the International Labour Organization. And so all these experiences make her a really good fit to give her view on the evolution of globalization, and an informed observer of the evolution of globalization for a long time. And so we are really glad to have Marion for this panel. Thank you, Marion. And the second speaker will be Christophe Gouel. So he will talk more specifically on the challenges, the current challenges for agri-food trade. And so Christophe is senior researcher at INRAE, and he's also a scientific advisor at CEPII, and he also worked at IFRI and World Bank prior to being at INRAE. And he's a specialist of the dynamics of agricultural markets, and in particular the cause of commodity price volatility and global food security and international trade. So this is really, this will be the focus of his topics. So thanks a lot to both of you for being there and giving your views on this issue of chaos in world trade and what should we expect and where do we stand first and what should we expect. And so we will have a 30-minute presentation by Marion and followed by 20 minutes for Christophe. And then we will have time for Q&As. So feel free to ask your question in the chat or let me know that you want to ask a question after the presentation, and I will give you the mic to ask your question. So thanks a lot again, and Marion, the floor is yours.
Thank you, Vincent, and thank you for the invitation. Very pleased to be here today, and very pleased to co-present with Christophe in this session today on chaos in world trade. I would like to ask you, there we go, the presentation is being uploaded, and I had already expressed to CEPII that I consider this title very telling and very interesting, chaos in world trade. That's what it feels like a bit where I sit, where we are having to advise governments on a very regular basis on what is going on in trade and what they could be considered doing in order to deal with unknown situation. And I'm taking advantage of the C in chaos to structure my presentation around 3 C's. I'm going to structure it around what I'm going to call a composition effect. I'm going to also mention a concentration effect, and I'm going to mention a confusion effect. And for the econometricians among you, do not expect that I'm going to decompose any trade flows into these 3 effects. I'm just describing a number of phenomena we are seeing and that have maybe put policymakers in front of new type of challenges around this challenge of composition, concentration, and confusion, where the confusion part is rather on the business side, I will argue. Next slide, please. Vincent already mentioned that trade went through a dip as a consequence of COVID, and this is one of the slides we regularly use when we talk about this, this phenomenon. And please look at these slides as slides that we are showing to policymakers here at the OECD when we inform them about what is going on in trade. So I'm using really material that we are using here, a very up-to-date and in daily interactions with our policymakers here. Now, this is our long-term trend chart where we look at what was going on with trade during this century. Most of us will remember the financial crisis. You see it here, 2009, 2010, as a dip in trade flows. We remember that trade recovered after the financial crisis, but that we did not find again the relationship between trade growth and GDP growth that we knew before the financial crisis. And then we got a new shock, a huge shock to the trade world when Corona hit. When you compare the 2 dips between the financial crisis and the Corona crisis, you see that the drop was of a similar magnitude, but the V was sharper in the Corona case, a sharper drop and a sharper recovery. So that looks a priori like a pretty good thing. But I will argue that this sharp recovery hides a composition effect that has actually put the global trading system under stress. And I will come back to that later. Next slide, please. Already before COVID-19 hit, we were looking very closely at the trade data because, as I mentioned, we were observing that trade growth was not exceeding GDP growth anymore, as had been the case in the 90s and the early 2000s. We also knew that business was a bit, bit uncertain after the financial crisis. We had new policy making in place with some aggressive policy making of the US vis-a-vis certain trading partners. So there was a lot of talk in business about shortening the supply chain. Now, Vincent already said that we didn't see an awful lot of this in many of our trade data, including the trade data that look into value chain trade, we did not really see a shortening of the supply chain, but here I show data that use trade in value added at the sectorial level. These data go up to 2018, that's our latest update, but we may already this year have an update until 2020. And what you see here is that when you compare the level of fragmentation in supply chains across in separate sectors between 2011, that's the horizontal line, and 2018, that's the vertical line, then we find all the bullets, nearly all of them, below the axis, and that gives you a stable relationship. So we would find that in nearly all the sectors, pharmaceuticals is one of the exceptions, the supply chains have become a bit less fragmented. So we see something, we started to see maybe something like a shortening, but this is one of the few data analysis where we see this kind of thing happening. When we look at the aggregate data for trade and value added, we do not see that shortening happening in the data that go until 2018. But there already some change maybe before COVID hit. But then came COVID. Next slide, please. And I'm going to argue that the big problem that COVID caused was a composition effect. We did see, as I mentioned before, we see monthly data, a big dip in trade, but a quick recovery that happened in 2021. But if you remember well what was going on in 2021, the big supply chain problems occurred in 2021. What we observed in 2020 was a certain lack of things like masks, of things like disinfectants, but then I think the community agrees that this was not due to supply chain problems, this was due to demand for these products having increased so much that producers took some time to deliver them. But what we started to see in 21 were real supply chain effects. Why? Well, one reason is that certainly to recover all this trade that hadn't taken place in 2020, a lot more had to be traded. So if you imagine how a supply chain functions, it means that more things were being produced, more things were being put in containers, more things were being shipped, and this put the whole logistics chain under a lot of pressure by the sheer amount of catching up that was taking place. At the end of 2021, the catching up was not complete yet. You see on the right slide the cumulative gap relative to cumulative trend. So we were not back to the trade, cumulative trade that we should have seen, but in 2022 we reached that level. So catching up, logistics chains under more pressure. Next slide, please. But this was not all. It was not only the case that in 21 suddenly much more was traded and that puts the logistics chains under pressure. Things that were being traded were different and the directions of trade were being affected. And that's what I'm here calling a composition effect. What you see here is a measure for the composition of trade, which products are being traded. And what we're looking at here, I invite you to look at the right slide, is how a measure that shows you how identical, how similar the structure in terms of product composition of world trade was in a given year with the structure in 2019. And what you see at the very right of the right-hand chart is a sharp drop from 1 to 0.94. This means that there was a big change in the composition of trade within 1 year. So I'm not talking amount of trade, I'm talking the shares of different types of products. And that's quite logical. We saw pharmaceuticals being traded more, but for instance, aircraft parts traded less because the whole aircraft industry collapsed. The amount of change in the composition of trade we have seen corresponds to what is a typical change that takes place over 4 to 5 years. Now, again, think of a logistics chain. Think of masks being traded or vaccines being logistically shipped, and think of aircraft parts. And you can easily imagine that the type of logistics behind these different products is very different. So the composition effect has an effect on the logistics chains, and chains that were built to work just in time were under pressure because the system had to adjust to this change in composition. This was the product composition effect. I'm going to argue next slide that has also been a direction of trade effect. This is a slide we were showing early 2022 to our members. What you see on this slide is that one player, China, recovered much rapidly in terms of production and trade than other players. Here you see in blue the Euro area and in yellow the United States. It is also interesting to look at exports to your left and imports to your right. We see in China exports increasing very rapidly, and this reflects notably that the country started to function normally again much more rapidly in the early phases of COVID than the Western world did. Exports recovered very rapidly, imports a bit more modestly, whereas in the United States, you see the yellow line going much higher than on your right, than on your left. Imports recovered more rapidly than exports. This notably reflects, in our view, the stimulus packages in the United States. So people in the US started to buy, whereas people in China were producing. Again, think of the logistics chain. This means that containers go full, more containers go full from China to the US, and less containers go full from the US to China. That's a simplified way, but this reflects the kind of supply chain logistics problems that we have seen, and you may have read about in the press, that containers were going in one direction empty, which is something that normally the distribution logistics community tries to avoid. Next slide, please. In the press, we heard a lot about problems in ports. These are 21 numbers. We have different types of problems. Or early 2020 numbers, 22 numbers, we have different types of problems now. But here we see the kind of stories that you heard about a lot. Queues of ships in the ports, long queues in, for instance, Los Angeles, long queues in, for instance, Shanghai. You see big numbers, 7397 in Shanghai, Jansen, but I would like to draw your attention to the following. Waiting time during those long queues in China were 1 to 3 days, whereas in Los Angeles they were 7 to 12 days. So the waiting times were becoming very long in the US ports, notably because the US ports tend to be less digitalized than European and Asian ports. That's a general statement, but that's something quite new in the specialized community. So composition effect, rapid recovery of trade after COVID-19, catching up puts logistics chains under stress, but then the fact that different products are being traded and that the direction of trade has recovered at different speeds in the different regions of the world, this has also put pressure on logistics chains. But we were confident that we would get out of this in Q2 2022. That's what you would have heard me saying at the OECD at the end of 21, still in January, and then the next shock happened. Next slide, please. And that's the Ukraine shock. And I'm going to argue, I will argue that the difference about this shock is that it has made us very aware of the problems with concentration in markets, and in particular the exposure to certain products from certain products that we are importing from Russia or Ukraine. Before I'm going to explain that here, however, a piece for thought. We are speaking chaos here, but there is in the community some thinking about to which extent has there been a strategy behind this from some players, notably Russia. Here you see Russian exports and imports, and you see that Russia since 2014, remember that's the moment of the Crimea crisis, Russia has been reducing its exposure to the European Union and Great Britain. It has been started to trade more with China and other parts of Asia, so that maybe puts them in a somewhat slightly more comfortable position to deal with sanctions that we are seeing now. But that's just an aside. Next slide, please. The real issue, the issue we are very much looking into at the OECD when it comes to the Ukraine crisis is the concentration and the dependency on Russia for certain critical markets. Now here, this is one of the type of visuals we use. This slide, this chart compares concentration in markets. So we're taking a particular good at a certain level of disaggregation on the left slide, on the left chart, and we look at on the vertical slide, is trading this good very concentrated? If it's concentrated, the dot is very high. And then towards the right-hand side, we check, is the global trade concentrated, dominated by Russia? So it's concentrated and dominated by Russia. If this was the case, we would find dots to the right at the top. Then it would be Russia who is determining the world trade. Now you see a few dots. If you look well, you see a few dots in the 40% area on your right, so where Russia has an important share in global trade. But these are very few slides, products. I will come back to them. So Russia is not a dominant player in global trade in by far most products. There are very few products where they have a dominant role. I will come back to them. And we know that Russia is in general a small player in global markets. They are not a big trader. But if you make the same chart for bilateral trade, so to which extent is the bilateral trade taking place in a product that has a where the country imports from very few players, vertical, and then to the right is that player Russia, then you see many more dots on your right at the top. So the more to the right and to the top, these are the countries where specific products come only or mainly from Russia. And in the press, and maybe Christophe is going to say more about this, you hear, for instance, that there are many Northern African countries who import their wheat mainly from Russia. So these countries would appear rather to the top and the right in this chart. So Russia, not a problem for global markets in most products, but definitely individual countries have exposure to Russia, big exposure to Russia for individual products. Next slide, please. Here you see some of these products. Many of them are in the agro-food, in the agricultural commodity space. Wheat is on top in the news, but they also play an important role, for instance, in corn. Energy products are in the news. Gas, you see very high up, but also certain other raw materials, some of which are important for the green energy transition. It's, for instance, the case of nickel. So if we want to get, for instance, to reduce our dependency on gas from Russia, have an energy transition towards green energies, but in order to build batteries or magnets or other things we need for the green transition, we need raw materials that are in Russia, then we continue to have a problem of dependency on Russia. So here, as to make the link with the previous slide, there are few products where Russia has an important global role. For some of these products, individual countries depend on Russia, and what you see here is that these products tend to be at the beginning of the supply chain, so they tend to be inputs. And I think that's something that we are paying attention to in a way that we haven't been doing in the past years. Is it more problematic if you depend on certain countries for your inputs than for other aspects of the supply chain? I expect more to happen in the research community in this field. Next slide, please. So concentration matters in the Ukraine crisis. Russia is a big player for some products, and only some countries have a big exposure. I mentioned Northern African countries for wheat. Now, in the case of Europe, it's energy. And here we see these are some of these dots higher up right that we saw before. When we look at the share of Russian gas supply in the European Union and United Kingdom, that's the red of the red bullets, and you see that that share of Russian gas supply is rather high. It's around 30%, and it has increased. It was higher in 2019 and 2021 than it was, for instance, in 2009. Now, this is an important challenge and something policymakers are currently having to deal with. So I explained the composition effect, something we are looking at into more depth as in the context of the COVID-19 crisis. I've been arguing that in the context of the Ukraine crisis, we are rather looking at the issues around concentration for particular products and for particular importing countries. And then the next slide, please. I think there's something else that we are only starting to look at now, which is what I'm calling the confusion effect. And that effect stems from new policies that are meant to function through the supply chain. Now, that confusion effect, that term really comes from our exchanges with the private sector. And I'm talking here about the kind of things that are mentioned on this slide. You may have heard that the United States introduced just before Christmas last year new legislation called the Uyghur Forced Labor Prevention Act. That act foresees that the US does not want to import anymore products that contain elements, inputs, composition that have been made in a region where forced labor may be taking place, and you were thinking explicitly of Uyghur forced labor. In a similar period, I think shortly afterwards, you may have heard in the press, Lithuania accepted a new presence of, we call it here Chinese Taipei in its country, and they called that representation the representation of Taiwan. That was very badly received by China. China put pressure on Lithuania and said, we do not want to import anything anymore that contains any elements or inputs coming from Lithuania. Now, why do I call this the confusion effect? Because in both of these cases, it is not clear how business is meant to show that products do not contain forced labor, or that products are not made in Lithuania and do not contain components made in Lithuania. So imagine I'm bringing an iPhone or a solar panel now to the United States. I'm the company producing the final product. I'm convinced that no inputs come from the Shenyang region, but I do not really know how to prove that. And then I find myself at the border with a border control that also doesn't know how to check. And this creates a huge uncertainty. And uncertainty, we know, is bad for business. Businesses currently do not know how these new type of policies are going to be implemented. And that uncertainty can cause a lot of havoc. So composition effect, concentration effect, confusion effect, next slide. And that together leads to quite a bit of chaos. That's the title of this presentation. I have been asked to say something about what we are doing about this, and I will only give you a few hints. We are being asked, and let's please go back to the previous slide, because the language is important here. We are being asked by our members to look at whether stronger ties among like-minded countries can enhance supply chain resilience. And I'm even reading this because the interpretation of this terminology will be rather important. And I can tell you now that this week, chief economists and senior economists from our governments, sometimes from multiple ministries, trade ministries, treasuries, agriculture ministries, are meeting in Paris at the OECD to discuss this question. Because this is a question that not only has definitional issues. What do you mean by enhancing supply chain resilience? What do we mean by stronger ties? We know what we mean by like-minded countries, our membership. But it also has actually methodological challenges, because we do not find it necessarily easy to assess these kind of questions. So here's some hints. Next slide, please. When we were discussing the food crisis and the potentially upcoming food crisis due to the fact that Ukraine is very much limited in its production due to the aggression of Russia against Ukraine, and to the fact that Russia is sometimes has been reducing its exports, not clear for which reasons. There has been a lot of talk in the press about the importance of Ukraine and Russia in agricultural commodities, notably cereals, and in particular there has been a lot of talk about wheat. Now, what you show here, and this is the kind of discussion we have been having with our members, when we look at the wheat market, yes, Ukraine and Russia were responsible for around 30% of world exports in the past, in most recent years. That was not the case 5-6 years ago, by the way, but has been the case last year. But OECD members are responsible for over 50% of exports of wheat. When you look at production, the world production of Ukraine and Russia together only represents around 15%, Ukraine only 4% or 5% of global production. So Ukraine's production falling away is not, it's a big shock, but it is, that sounds much less dramatic than losing 30%. And here to remember, OECD countries are definitely not on the crisis side of things. OECD countries, in particular the EU, are rather net exporters of most commodities, agricultural commodities. Not all of them, but most. The question is, what does this mean for the role of our members in being able to buffer off a potential food crisis? Next slide, please. I mentioned to you the dependence of certain raw materials of Russia for certain raw materials. One of the things we have started to look at is what if we do not import any more of those materials from Russia? Here we look at nickel. Russia produces 11% of nickel in the world. And then what's something we are looking at, and something the business is not looking at, to which extent would it make sense to start investing in mining elsewhere if Russia is out of the market? And then we look at where are the reserves of this kind of raw materials, and we see that some of these materials are in OECD members or G20 members. Here we see Australia, big reserves in nickel, but also Brazil and India. Next slide, please. And that's the last slide with data. This is a slide, a larger one, part of a material we have submitted to the G7, because at the G7 level there is a big interest in dependency on Russia for raw materials. So we have been looking at important raw materials here for the energy transition, imports from G7, and here this slide shows what are the known reserves of these materials. And here we see, for instance, that a country like Australia doesn't only have nickel, but also quite important reserves of lithium and cobalt. Cobalt, of course, being mainly produced currently in Congo, in the Democratic Republic of Congo, but also Chile has important availability of raw materials. And here we're notably thinking of lithium that is important for batteries for electric vehicles. So right now, mainly discussion of who depends on what and what is available where, but what this means for stronger collaboration among OECD members or with other like-minded countries in order to come out of the chaos generated by composition, concentration effects, and confusion in global markets. Where this leads us is not entirely clear yet. What is clear is that we at the OECD are helping our members as much as we can to come through these difficult and challenging and very, very unusual periods. I thank you very much for your attention, and I look forward to the discussion.
Thank you, Marion. Really, thank you for this great overview of the last 10 years of globalization and this issue. So the 3C of raised by the COVID crisis and the war in Ukraine. So before turning to a general discussion with the audience, I suggest that we have the presentation by Christophe, so that we have this focus on agri-food trade, and then I will open the floor for discussion with the audience. So Christophe.
Okay. Thank you, Vincent. So I'm sorry if you hear some background noise, because there are some renovation work in the flat just above mine. So in the limited time I have, I would like to explain you that we are in a very specific food crisis, contrary to the previous ones. So here, so now it's coming. Here you have the FAO food price index in real terms, and you can see the four food price crises that we have had since World War II. We had the food crisis in 72, 74 here, a big one. We have the recent ones in 2007, 2008, and 2010, 11 here. And now, so now we are exceeding the price index from the crisis in the 70s. But what you can see here is that I have put here the war in Ukraine, but you can see that the prices increased already a lot before the war. So it was already a significant food price spike before the war. So the war added tension to an already tight situation. So now I would like to discuss how important is Ukraine for ag markets. And Ukraine is both a big and a small player. It is a small player in terms of production, but it's a big one in terms of trade. So at the world level, Ukraine produces 3% of maize, 3% of wheat. It's only really big for sunflower, with 26% of production and 5% of production for barley. But in terms of trade, it's another story. It's 15% of trade in maize, 9% in wheat, almost half for sunflower, and 13% for barley. So here, you should have in mind that a lot of big countries like China and India, they aim to being close to self-sufficient in some key ag commodities like wheat and rice, which means that you have just a few key countries that are really export-oriented. And Ukraine is one of them. When you look at sunflower, it seems to be really big, but actually it's part of the oil complex, and many vegetable oils are substitutable. So their prices will move exactly in the same direction. So you should see it as part of soybean oil, palm oil, and so all the other oil, and then you would have a smaller share. But anyway, it's a big shock for trade, a smaller one for production. But ag markets are used to shocks. Here you have good harvest in one country, bad harvest in another one. And here I have tried to summarize the yield deviation from trend for maize, and then I will do it for wheat. So what you can see is that some years you have yields that exceed the trend by 9%, and some years it can go up to minus 13%. Losing all the production in Ukraine would mean a shock of minus 3%, which is something that we have seen historically. It's not such a big shock, and actually we have not lost the production in Ukraine. Ukraine has already been able to export a lot of its production, but in addition to losing part of the production in Ukraine, we have to add the usual shocks. We have had 3 not very good harvests in the last 3 years. So as you can see, we have been below the trend for the yield in maize. So if you add to a not very good production, which is almost 4% below the trend, you add the war in Ukraine and you lose almost 3% of production, then you start to be in a situation of quite large shock on the maize market. And the story is quite similar for wheat. So what you have in orange is the one standard deviation negative shock, and in green, a 2 standard deviation negative shock. And so the Ukraine shock is less than a 1 standard deviation. But to this, you add again bad harvest in wheat in the last 2 years. So eventually, you have quite a big shock in the ag market. But a big shock is not enough to create a price spike, because depending on the years, we have had big shocks without price spikes, because there are other means to deal with shocks. Except that here, this means have tended to lose their effect. So let me explain a bit. The first thing we see during a food crisis is that a lot of countries are putting export restrictions. And this crisis is no different from the others. So what you can see here is the share of trade in global calories that are covered by export restrictions. So if you look at the food price crisis in 2008, at some point, almost 50% of trade was covered by export restriction. So what is going on here is that you have a lot of countries with an important poor population, and they want to avoid to have some Arab Spring, to have a pricing. So what they do is that they try to cut their market from the world market by putting export restriction, and then it cools down their domestic inflation. But by doing so, they limit the size of the world market, and so they limit the possibility to absorb shock at the world level. But we know that this happens for every price crisis, and this is happening again for the war with the war in Ukraine. And we are again as about 15% of global calories that are covered by export restriction. And the number of countries imposing this kind of restriction has increased to a level similar to the previous price crisis. And even during the COVID crisis, we had also a small share of export restriction, but it was more limited. Here you have a map of the countries imposing this export restriction. So one big cycle is in Russia. You have also India. I think you have heard about it. India recently closed its market because they were expecting very bad harvest for wheat. But actually, my impression is that even if we have a lot of export restriction, like in all crises, they may not have played such a big role as before. Why? Because even if Russia is currently putting an export ban, Russia has exported a lot before the export ban, also exported a lot of grain stolen from Ukraine. So they have provided a lot to the world market. India, it is the same. India, before putting their export ban, they have exported 8 million tons of wheat, which is almost 4 times more than what they usually export. So even if they have put their export ban, they have contributed a lot to the world market. So overall, the world market has rather well worked for this crisis, much better than previously. And what is really striking is that we are not seeing anything happening on the rice market. And we are very lucky for this, because each time there is a food price crisis, the main problem is usually happening on the rice market. During the crisis in 72, 73, the world rice market disappeared for 9 months because of all the countries putting export restriction. You can see this huge spike in 2007, 2008 on the rice market. But I can tell you that the rice market at the time, there was no real problem. There was no bad harvest. The production was perfectly fine. This price spike was just explained by countries putting a series of export restrictions and drying up the world market. But now we are saying that the rice market is fine. And this is very important because the rice market, to make it simple, it's a market for poor countries. You have a lot of poor countries in Asia, in Africa, that depend on rice. And when you have a panic on the rice market, you have a lot of people affected. And so it's extremely important that the rice market is holding. Just to finish on the rice market, if we look back at the situation in 2007, 2008, the crisis was just a purely self-inflicting crisis. At some point, the world price of wheat was increasing and the harvest in India was not that good. And so India started banning export of wheat and rice to protect its domestic market. And following this, all exporting countries did the same. Vietnam and Egypt, and importing countries started buying like crazy, large amount in very short time, like Philippines, and more countries banning their export. And things ended when Japan, which for some trade policy reason has to import rice from the US, but does not consume it, and so has some stocks of rice, agreed with the US to be able to export these stocks. And once this decision was made, they actually did not really export it, and the crisis was over. But there was no, as you have seen, as I told you, no harvest failure and no real export of emergency stocks. It was just countries driving a kind of bubble at the world level by closing their markets. So we are lucky to not have this crisis related to export restriction. So the other part usually driving crisis in food markets is related to stocks. So here I just need to do a simple detour through the basics of commodity price dynamics. So here it is something that I always show to my students, which is that these markets behave non-linearly because of storage. When you have a lot of stocks, when you have a bad harvest, so let's say that you have your production that decreased by epsilon, like here, then you will have a price increase. But if you have a lot of stocks in the market, this price increase is moderate, because what will decrease is the amount of grains that are stored. But on the other hand, if you have very low stock levels, then when you have a bad harvest of the same size, a shock epsilon, then you will have a large price increase. And that's because it's no longer the stocks that can adjust. That's the people consumption. And as you can expect, people are not ready to reduce their food consumption, even when food prices increase. So for wheat, to take an example, the price of wheat has doubled in the last 2 years. But I would guess that none of you have decreased their consumption of baguettes or of pasta. And that's because if you think about the baguette, you have only 8 cents of wheat in the price of your baguette. So even if you still have another doubling of the price of wheat, it won't affect much your consumption in developed countries. And so we are really, we really resist decreasing our consumption. So we need huge price increase for this decrease. So which means that we should expect that in a crisis, we should be in a low stock situation, because that's when you have a shock like the Ukraine crisis, well, we should see the increases. So is it the case? No. Well, the answer is no, and this is really disturbing. So here you have a figure of the stock to use ratio. So the amount of stocks available divided by the consumption in the year. And what you can see is that when during the crisis in the 70s, we were in the lowest possible stock level. During the crisis in 2007, 8, and 2010, same thing, very low stock level. But currently, in maize, we have very high stock levels. If we look at wheat, it's even worse. In wheat, we have historical levels of stocks. That's what we have here. And as before, during the previous crisis, stocks were at the bottom. So how do we explain this? One intuition is that, well, okay, we have the war in Ukraine, and we have all here about the negotiations with Putin to make sure we could export the grains that are stored in the silo in Ukraine through the Black Sea. So we should expect a lot of stocks in Ukraine, and that could explain this. We cannot use these stocks; they are stuck in Ukraine. Well, actually, that's not really the case. For maize, here are the stocks in Ukraine. They are 6-7 million tons. Obviously, there's some uncertainty about this. It's more than usual. At this time of the year, Ukraine should have only about 1 million tons. But as you see, it's small. I mean, in the United States, you have much more stocks. In all the other countries combined, if you add 1 million ton here, another there, then you get to much more stocks. In Europe, we have almost 9 million tons, but the bulk of the stocks, they are in China. We are speaking of more than 20 to 200 million tons in China. And the story is the same for wheat. For wheat, we have 5 million tons stuck in Ukraine instead of 1 million at this time of the year, and more than 140 million tons in China. So basically, I mean, instead of hearing a lot of diplomatic talk about getting the wheat out of Ukraine, I'm not sure why nobody is talking about diplomatic talk with China about getting the wheat out of China. And it will be a super beneficial operation for China because they have bought this wheat on the world market at $200 per ton 2 years ago, and now they could sell it at $400 per ton. So if we look back at the stock levels at the world level without China, then we are back to something more expected. Low stocks in the previous crisis, and now we are having moderate stocks. But if we removed the stocks in Ukraine, we would be at really low stocks for this crisis. So you are saying that this food crisis is really not like the other one before. We are having a food crisis despite having plenty of stocks, but they are stuck in China. And we have a lot of export bans, as usual, but we have one key market that is holding, which is the market for rice. And this is super important because if the rice market were breaking down like before, this would be really dramatic. Thank you.
So thank you, Christophe, and for this detailed presentation. So I can see that there are some questions that are coming in the chat. So maybe just before raising this question to you, maybe let me ask a question myself, and maybe this is related to more to Marion presentation, but I'm wondering what do we mean by supply chain resilience? You raised this issue at some point, and I think one issue in my mind is, does it mean the same thing for businesses and for states? And do we aim at the same thing for businesses and for states? And this is related to the many surveys that we can see today that suggest that one of the top priority of business executives is to diversify their supply chain, or some nearshoring, or this kind of fancy words. And we don't see much in the data. And so this is for sure for the war in Ukraine, but we had the same kind of survey just after the COVID-19 crisis. So I was wondering whether there are different incentives for businesses and government in your mind, and how this could explain the fact that we don't see much. Or maybe this is just time for investment, and this takes time, and we should expect this in the future. But I'd like to have your views on this, maybe before raising some question from the chat.
Yeah, thanks, Vincent. Whether there are different interpretations given to this term resilience, it is often related to the objective for supply not to be interrupted, so to ensure that you can continue functioning at your normal level. But it's also sometimes related to, if I get a shock and business is interrupted, can I come out of it very rapidly? So can I adjust rapidly to this kind of shock? But an interesting aspect of your question are the objectives different for businesses than for governments? And that's something we have looked at in quite some detail for a tool we developed, and you will find online our OECD keys for resilient supply chains. And there we tried to explain to policymakers, how does a supply chain manager think about his or her supply chain, and how should you as a policymaker think about supply chains from your position? And the question of where may your policymaker objectives differ from the company objectives, it comes up in that assessment, and it's only there where there could be potentially a role for the government. And what this role could be, it also depends on what the objectives of the government are. Let me give you an example, Vincent. If I'm a pharmaceutical company and I'm based, let's say, in my home country, Germany, I optimize my profits, assume I make vaccines, and I want to sell vaccines to the globe. And I optimize my sales and my profits with regard to global demand. Now, if I'm a German policymaker, I would like to make sure that my German population has access to vaccines. So to the German policymaker, it matters whether the vaccines go to another country or stay in Germany. So there, when it comes to ensuring a minimal supply of essential goods, this is an area where sometimes business may have a different business objective than the policymaker has. And therefore, the discussion of how to ensure resilience of supply for essential goods, it's something that we have seen since the beginning of the COVID-19 crisis, notably in the G7 context. The question then arises, what do you call an essential good? And once you have defined it and you have understood what you want to achieve as a policymaker, how are you going to achieve this? Now, diversification of access to supply is sometimes something that both the policymaker and the business may want to achieve. But then what could be a role of the policymaker there? Would the policymaker say to a company, you have to source your inputs in X number of countries in order for your supply chain not to be interrupted? Would this be something that is imposed? Or would it be something that is encouraged, for instance, by making trade agreements with more countries, or ensuring that there is regulatory harmonization with more partners from whom we want to source? So these are the different options policymakers have. And if you go through that tool online, you see the different think processes policymakers may want to go through. In that tool, we do not say that's what you should do. We just say that's how you should think about it. But one thing that is important, and we highlight in the tool and in all our outreach, is for this supply chain resilience, you will have to speak to business. Because ultimately at this stage, still, the intricacies of the different supply chains, it's business that understands them better than we do as trade economists. There are certain aspects we don't see in the normal data and better than the policymakers do. So some type of platform that allows for policy, private sector, exchange of information, coordination, collaboration, that's again to be determined how much. That's probably going to be very useful in order to increase supply chain resilience. But I think the first step we have been triggering is a thought process on how to think about the different options and how to position ourselves maybe a bit differently in this, depending on what policymakers' objectives are.
Just maybe a follow-up question raised by Sandra Ponce, who is asking what concrete policies are currently discussed in order to strengthen ties between like-minded countries. So this is related to friendshoring, or is there any? And she asks, is there any room for trade policies in this, as most tariffs are likely to be close to zero between like-minded countries? So you were talking about trade agreements, so this is more than tariffs for some of them, but are there concrete steps in this direction, you think?
Well, I think definitely regulatory aspects of the trade, so the whole area of non-tariff measures would be on the agenda for this type of discussions. These collaboration at the regulatory level, and we have seen that within the EU, they are very useful in times of crisis, because they give a certain certainty that products can continue to be traded, and they make it possible to have also crisis processes. For instance, countries that are like-minded can agree during COVID-19, a crisis like COVID-19, to speed up processes at the border, or to reduce the number of checks in order for things to go more rapidly, or to go into digital more rapidly, because in order to ensure that things keep flowing. So it's also more easily to set up crisis protocol among like-minded countries. Yes, trade agreements already exist among like-minded countries, but for instance, the EU and Australia do not have a trade agreement yet. So these are discussions that are currently going on. But we are seeing very concretely a different type of collaboration in the context of the US-EU collaboration around technology that goes further in the direction of maybe joint investment, joint R&D, and that's something new that we are currently seeing happening in the policy space.
Thanks a lot, Marion. Maybe some question for Christophe on the chat. So there is a question by Akiko. What is the role and importance of speculation? And maybe a long question by Alan Matthews on the role of imports in this. You mentioned export restriction and export ban, and the role of import. So maybe you can take this first, these two questions, and there are some two additional for you after that.
Okay, speculation. So that's a kind of a usual suspect in all food crises. We have to be clear, all price movements in these markets are speculative. And we don't know exactly what is the size of the size of the problem that the war in Ukraine is causing. So markets are reacting depending on the various people's expectation of how much will be lost and how large will be the disruptions. And that's speculative movement. But this is, on the other hand, good speculation. I mean, we need people to try to think what will be the difficulties in supply and to make bet on it so that the prices adjust immediately to give the good incentives for storers and for producers. So what we cannot know is if there is any excess in this. I mean, have we seen a price increase which is excessive compared to the fundamentals? I don't know. And one reason why I don't know, and I think nobody can know, is that we don't know exactly what are the fundamentals. I mean, it will depend how much we can get out of the silo in Ukraine, how much they will be able to harvest this year, and how much will be destroyed by Russia. So there is a lot of uncertainty. So it's obviously speculation, because that's the way these markets work. But it does not mean that it's bad. And we don't know if it's bad. It's difficult to know if it's bad or not. Regarding Alan's question, so the point of Alan's question is to say, okay, you are criticizing export restriction for fueling the food price rise, but on the other hand, there is a symmetry, which would be decreasing import barriers, and all importing countries do the same, and that's perfectly true. And I mean, I have the same bias as everyone, and here I have taken a figure coming from the export restriction tracker from INRAE, and they are not following all the changes in import policies. They are just following the changes in export restriction. So I cannot know if in the current crisis there is anything that is fueled by the fact that many importing countries are decreasing their tariffs. But what I can say is that what is also quite specific about this crisis is that, contrary to some previous crises, countries are not rushing to import. Last week, France Agrimaire, so the organism that track the statistics about agricultural trade and production in France, has decreased the expectation of France exports and increased France stocks. And they are basically saying that, okay, France is competitive in the market, but actually the prices are so high that countries are not willing to import for now. Which would not have been the case in 2007, 2008 on the rice market, because countries that were expecting the market to collapse. What is specific with the wheat market is that it's more a market of developed countries. I mean, for the producers. You have Australia, Canada, the US, France, and that's reliable countries. That's not countries that we put export bans. So even if you do not import right now, as long as there are still available stocks somewhere, you know that it will be possible to import later. It was not the case on the rice market. In 2007, 2008, you had to rush to import. And so there is a kind of wait and see currently in the markets. And that's why you still have some non-negligible stocks in exporting countries.
Thanks, Christophe. Marion, feel free to share your mind on agri-food trade, because you're also a specialist on this issue. So if you want to add something, feel free to add something.
Yeah, thanks, Vincent. And I think that Christophe's presentation highlights one important forum for discussion for the food market situation, and that is the G20. We hear from Christophe that a country like China has huge stocks. We also know that Russia has been threatening to restrict exports, has been sometimes restricting exports, and Russia is also an important player. India is an important player. China and India are the biggest producers, I think, of wheat. So all these three countries are members of the G20. During the COVID-19 crisis, the G20 was very successful in avoiding export restrictions, notably in the food markets. That was partly because of the experience during the 2009 to 2010 crisis. And some of you may know this instrument, AMIS, Agricultural Market Information System, and that was an information platform created by multiple agencies under the lead of FAO, but upon demand of the French G20 presidency during the financial crisis. And that platform is meant to provide information on the type of data that Christophe has been showing, how much is being traded, what are the policies, what are the prices. The information is not perfect, but it provides transparency. So in 2009-2010, we learned that we need to remain calm when it comes to agri-food markets. We need transparency. We introduced the transparency mechanism. All this was applied successfully during COVID-19, but in the Ukraine situation, we are less successful. You see, for instance, in the news, often data that are different from the AMIS data. And this is the question I've been asking policymakers. Why have we been less successful in this Ukraine crisis? You've seen in Christophe's charts that export restrictions, the number of export restrictions are much higher now than during the COVID-19 crisis, or they have a similar level but are not going down. Why is this happening? And I think this is a discussion that should take place at the G20 level, because the most important players of the markets we are talking about are there. Those who are suffering if we do not get an agreement, those will not be at the table. And I hope that G20 policymakers will be responsible and will live up to the expectations that we have to.
Thanks. So maybe we have time for one or two questions more. And one maybe which is related to it appears in several questions. Should we be worried about China and the power of China due to the stocks? And there is a question on whether these stocks have increased in preparation of some events for that could happen in the future. But also in general, because you mentioned the events between China and Lithuania, and so the weaponization of world trade and trade links, and which was related to your confusion, Marion, and the third C confusion. And I think this is what's really, is it what's really specific in this war in Ukraine, completely different from what happened during the COVID crisis, and maybe which raise additional issues for cooperation between states, because here we are looking at weaponization of trade links, and so new different issues than issues related to the disorganization of global value supply chains, which were more related to the composition and concentration that you mentioned in your presentation. So maybe this is an issue which is common to both of your presentation.
Maybe I kick this off and then pass over to Christophe. The trade discussions have become much more geopolitical already for some time. I think when you were announcing this event of CEPII, reference was also made to trade policy changes under the previous US administration. I give you an example. The European Union is introducing a coercion instrument that allows the EU to react in case another player weaponizes trade, tries to push them into something by using trade measures. Now, that instrument was originally developed in reaction to an instrument used by the US. You may recall that the United States started to use SWIFT against the EU in the sense that it did not allow actors to trade anymore with Iran, and was applying that to anybody who would be using SWIFT. So was threatening to attack SWIFT, and if SWIFT cannot function anymore, then the entire trade collapses. So that was a new type of measure that is now being applied against Russia. I think we are in a situation where we have a new dominant player in world markets. This is China. This is calling for a re-equalization among trading powers, but that finding that new balance is not only something that is taking place in trade, it's taking place in financial markets, it's taking place maybe in other geopolitical and geostrategic contexts, including military. Trade is part of that finding the new balance, and this may make the coming years increasingly uncertain. There may be continued confusion and continued change, and the Ukraine situation has added a complication to this, because we see that also a player like Russia, because of its importance in some raw material markets or primary products, can put pressure on global markets. So we are braced for a not so easy period, and we are talking with our members, but also with non-members about how to come the best through this difficult period. Personally, I am very happy that in the ministerial conference at the WTO, there have been a number of successes, and that the multilateral community has been able to make a number of deals. I think that's a very positive signal, and I look forward to additional positive signals from G20 meetings.
Okay, maybe just as a follow-up of what Marion said previously, maybe what we are not seeing on the rice market, the stability we are seeing on the rice market, could be an outcome of AMIS. We are lucky to have a rice market that is stable, and maybe because countries are able to coordinate on the fact that, well, the fundamentals of the market seems to be right, and there is no reason to panic. So now let's move to China. So the first thing to acknowledge is that I don't think we have official numbers about the China stock. What we have are estimates by the US Department of Agriculture or by the International Grain Council. So the numbers may be wrong, but that's what we need to do. That's what we have. These stocks are in a very high range historically. So they have been almost as high in terms of stock to use previously, but now China is supposed to have almost or more than 1 year of consumption in stocks. And it has followed a rebuilding of their stocks in the last 2 years. So they have started importing a lot for both for feeding their pigs following the swine fever, the African swine fever, and in addition to rebuild their stocks. Was it in preparation of a new war or something else? I cannot tell you. I'm not an expert of China. Apparently, they put a lot of emphasis on food security and autonomy for the world market, and they build their stock. But I'm a bit puzzled about why they are not precisely using these stocks in their diplomacy. I mean, they could they could do country-to-country bargain and export their stocks with some ties to countries in need, but they are not doing it. So it seems that, I mean, they're not really weaponizing stocks, except if we think that they have built their stock precisely in the expectation of this kind of events and holding to them to put pressure on the world market. They just seem to be not considering what is happening on the world market and just letting it happen without touching at their stock. But I've not seen anything said about the strategy, Chinese strategy about these stocks, and I don't know what it is. So that's a bit of a puzzle in this crisis.
Okay, thanks, Christophe and Marion. So we reach the end of this meeting. So I would like to thank you both of our presenters, of our speakers. So thank you a lot for sharing your views on this really topical and timely issue of globalization. I guess we will have other meeting and reunion to discuss this type of issue, which won't disappear in the coming months. So thanks a lot again, and this is the last meeting of Club du CEPII before the summer. So we will see you after the summer, and we have a presentation which has been announced in the chat for Economie Mondiale in the 7th of September. So thanks a lot. Have a nice summer, and see you soon.
Merci.
Thank you. Goodbye.